Hey, welcome back. It's Jason Walter here. In today's housing market update, I'm going to be sharing some news that cash sales in the US have increased greatly this year. I'll discuss which US cities had the highest share of cash sales and which ones had the lowest. I also have an update for you regarding home prices, housing inventory, and mortgage interest rates. I have a lot to cover in today's housing market update, so if you get any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. So with that said, let's begin today's video. The share of houses purchased by cash this year increased to 30%. This is the largest share since at least 2014. 1 year ago, the share was 25.3%. And for comparison's sake, the largest share of cash sales over the last 20 years was in 2012 and 2013, when 34% of all sales were for cash buyers. Affluent Americans have benefited greatly from a surging stock market. So for example, the S&P 500 is up almost 40% from 1 year ago. So if you had $100,000 invested in the S&P 500, then 1 year later, you would have almost $140,000. Another reason for the increase of cash sales is for those who can work remotely and move from more expensive cities like New York City and San Francisco to less expensive areas. For example, if you sold your 1,900 square foot home on a 0.08 acre lot in San Francisco for $1.8 million, then you can move to Austin, Texas and buy a $1 million home that's twice as big that sits on over a quarter of an acre. And then you can take the remaining $800,000 so you can buy yourself a purple Lamborghini Aventador SVJ. The share of all cash sales, of course, varied by the area. So for example, when looking at the top 5 cities with the highest share of all cash sales, 4 out of the top 5 were located in Florida, with West Palm Beach in the top spot. Surprisingly, at the bottom of this list was Oakland and San Jose, California, with a 12.5% share. The National Association of Realtors, or NAR, also released their weekly mortgage monitor report today, so I want to share that with you because they reported in here that contract signings, which is pending home sales, actually have been decreasing despite an increase of housing inventory. Contracts signed for the week ending July 11th, which is pending home sales, decreased 7% from 1 year ago. Meanwhile, the active listings that came into the market in the past 4 weeks rose by 4.3% from 1 year ago. So while the gap between demand, which is pending home sales, and supply, which is active listings, is starting to narrow, there is still a large demand to supply gap. The inventory of active listings as of July 11th was down 28% from 1 year ago, while the number of pending listings was up 7% year over year. What this basically means in a nutshell is that demand for real estate is still far exceeding supply, but that gap is narrowing. For example, housing supply was about 50% what it was a year ago earlier this year, and now it's only down 28%. The National Association of Realtors also shared an update regarding home prices, so let me share that with you right now. Due to demand still outpacing supply, home prices have continued to rise. For the week ending July 11th, prices are up by 18% from a year ago. However, home price growth is decelerating. So in May, the median sales price rose 24% on a year-over-year basis. Also, on average, houses are not selling for well over the asking price anymore. So I noticed that the average sale to list price ratio was only 100.4%. That means on average, homes sold for 0.4% above the seller's asking price. Houses are still selling very quickly though. The average days on the market is only 15 days in the US. In the Sacramento region, it's only 6 days. All right, changing gears slightly, CoreLogic also released their latest national delinquency rate, so let me share that with you right now. For the first time since March of 2020, the national delinquency rate decreased on a year-over-year basis. It fell to 4.7% in April. The share of mortgages that were 30 to 59 days past due, considered early stage delinquencies, was only 1% in April 2021, down sharply from a post-pandemic high of 4.2% in April 2020. The serious delinquency rate, which is defined as 30 days or more past due, including loans in foreclosure, was 3.3% in April, roughly 3 times that of a year ago, but down from a recent high of 4.3% in August 2020 and from 3.5% in March 2021. CoreLogic went on to say that despite an increase of serious delinquency rates, the chances of a foreclosure tsunami is unlikely given the large increases of home equity, given that we have record high home prices. The rate of mortgage delinquencies also varied greatly by city and state in the US. So let me share the states that have the highest rates and which ones had the lowest. Louisiana, New York, Mississippi, Maryland, and New Jersey were the states with the highest mortgage delinquency rates, all with rates of greater than 6%. In contrast, Utah, Wisconsin, Montana, South Dakota, and Idaho experienced the lowest delinquency rates, all below 3%. Out of the top 10 largest U.S. metros, Miami and New York had the biggest delinquency rates of over 7%. In contrast, San Francisco and Denver had the smallest rates of 2.9%. Something I wanted to point out was the fact that Miami was definitely at the top of this list, but rates have been improving there. So rates decreased there by 3.9% percentage points from 1 year ago. For those of you who know me and for those of you who follow the channel, you know I like to share leading indicators of our housing market so we can gauge where our housing market is headed in the months to come. One of these leading indicators is showings by real estate agents with their clients for houses listed for sale. And I mention this because the National Association of Realtors released June's report today, so let me briefly share this with you. Real estate showings on a national level were down 1% from 1 year ago. However, what I like to look at is showings per card. So every house that's listed for sale that has a lockbox has a card. So in order to gauge homebuyer demand and homebuyer interest, it's best to look at showings per card to see how many showings each listing received. At a national level, showings per card decreased by 17% year over year in June 2021. I'd love to hear your thoughts about this, but my opinion about this is that I'm not really surprised at all by home showings decreasing on a year-over-year basis. And this is because in June of 2020, our housing market was absolutely skyrocketing after the pandemic lockdown was lifted in late April to mid-April. And when compared to the prior month, showings per card declined slightly from 4.7 to 4.4. In addition, showings per card decreased year over year for all regions. The Northeast decreased by 43%, the Midwest by 24%, the South by 18%, and the West decreased by 6%. To give you a quick mortgage interest rate update, according to the Mortgage News Daily, the average 30-year fixed rate mortgage decreased from 3.09% to 3.04% today. Rates are still not far from the all-time record low of 2.75% that was set in January of this year. Check out the links below if you want 2 free stocks. Also, if you want an agent referral for virtually anywhere in the US, check out the links below. Also, if you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. And also consider subscribing as well. I post frequent housing market updates so you can make a more informed decision about whether to buy or sell a house. Also, you can follow me on Instagram. I'm Sacramento Realtor. Hope you have an awesome day, and I look forward to seeing you on the next video.